Mhm.
Good evening, all. The program will commence soon. A warm good evening to one and all, welcoming each and everyone who are here for the first day of National Level Faculty Development Program on recent trends in accounting and taxation, organized by the Postgraduate Department of Commerce in association with ICAI Kottayam branch and IQAZ. Myself, Chinmay Shankar, first year student of BCom Finance and Taxation. The Postgraduate Department of Commerce of Tuticorin College of Management and Technology, affiliated to Mahatma Gandhi University, serves to be a true academic center of achievements for the decade. The Commerce Department, being the largest department, forms the backbone of our institution, offering Bachelor of Commerce with specification to computer application as well as finance and taxation streams. The post-graduation course, that is MCom Finance and Taxation, offered by the department is equipped with academic and research-focused initiatives that nurtures competencies among students. The Department of Commerce marks its base since 2005 and continues its academic journey for the past 16 years with great spirit. Now we have BCom Computer Application 2 batches, BCom Finance and Taxation 2 batches, and MCom Finance and Taxation, offering learning platforms for around 800 students in each year. Being the largest department, the working team of Postgraduate Department of Commerce includes 22 commerce faculties, 3 language faculties, and 2 computer faculties. The success saga of a department is immensely appreciable, and that had added more jewels to the crown of her flourishments. The Postgraduate Department of Commerce sparkles with 48 university ranks till this date, which includes most precious achievements like 5 ranks for MCom Finance, including first rank in the year 2019 for Ms. Neeraja S. Raj. It feels really proud to say that our department has been consistently securing first rank in BCom Finance and Taxation since 2016. Our department backed ranks in BCom Computer Application since 2009. The academic credit of our institution includes 9 national paper presentation competitions, 1 national conference, 10 ISBN edited books, 6 clubs, which includes Research Club, Entrepreneurship Development Club, Revital Club, GD Club, Artistic Club, and Career Club, for functional MOU collaborations, career counseling program, competitive examination guidance program, internship training, mini projects, value-added and certificate courses, etc. till this date. The Commerce Association Esprit and its activities also focuses on imbibing leadership and employable skills among students. The Alumni Association of the department is a strong force that always regenerates our endeavors. The academic as well as personal orientation intertwines with placement opportunities enable the students to explore the possibilities of this academic career. And in this occasion, we are also proud to say that the Postgraduate Department of Commerce is ready to be in front of you with our 3-day international conference scheduled on September 23, 24, and 25, which is considered to be one of the greatest milestones of our academic initiatives. And also so happy to say that we are moving to the NAAC first cycle evaluation by July 2023. Now it's time to move with great pleasure to this academic initiative, the second faculty development program organized by a department in association with ICAI Kottayam branch and IQAC on the topic recent trends in accounting and taxation. So with great excitement, we can move on to this academic endeavor. For all good deeds, we need the blessings of Almighty. So I invite our department choir for a Sanskrit shloka.
अखण्डमण्डलाकारम् व्याप्तं येन चराचरम् तत्पदं दर्शितं येन तस्मै श्री गुरवे नमः। त्वमेव माता च पिता त्वमेव त्वमेव बन्धुश्च सखा त्वमेव त्वमेव विद्या द्रविणं त्वमेव त्वमेव सर्वं मम देवदेव त्वमेव सर्वं मम देवदेव त्वमेव सर्वं मम देवदेव।
We are glad with the presence of you all. Inviting each and every one of you is an inevitable part of this program. For that, with due respect, I invite Dr. Varghese Antony Sir, Vice Principal and HOD of Commerce Department, to extend the words of welcome. Sir, please.
Good evening, one and all present here. The Postgraduate Department of Commerce feels it really very happy to organize this National Faculty Development Program on recent trends in accounting and taxation. And we are so proud in this occasion. And we are so happy to see this much participants from different areas. And that's actually credit to our minds. So, first of all, Chinmay, thank you so much for giving me this opportunity to welcome this gathering. So, first of all, I would like to welcome our dear principal, Reverend Father Joshi Chiramkuri CMI. Although he is absent in this occasion, I extend my heartful welcome to you further. And not leaving a while, I like to invite the beloved resource person of this day. As you all know, you are waiting for his conversation, right? CA Amal Paul, the partner of Sebastian Academy, that is Sebastian Chartered Accountant, and he is an audit manager. He has also enormous teaching experience in the field of chartered accountancy. And we are so happy. We are so happy and privileged to have you here, sir. So with due respect and with great honor, we welcome you, sir, to this occasion. Welcome, Amal, sir.
Thank you, sir.
Okay, welcoming our the advisory board member, Dr. Matthew Emmanuel, course coordinator, Tom Scutiemo, the coordinator, IQSC coordinator, Dr. Anu Anthony, and all the teachers of our institution, as well as all the teachers who have joined this in this program from different parts of our nation, and to make this program a successful venture. So we are so proudful. We feel so enchanted and proudful to organize this academic endeavor as part of Postgraduate Department of Commerce in association with IQAC and ICAI Kotem. So once again, welcoming you all to this gathering. Thank you.
Thank you so much, sir. And I honorably welcoming you, sir, to this gathering. Lighting a lamp always sheds away the darkness of ignorance. Even though it's a virtual meeting, we are equipped with the lamp lighting ceremony, which symbolifies as the official inauguration of today's endeavor. So let's move on to the lamp lighting ceremony. I invite your attention to the screen, please. Yes, the time that you're waiting for has arrived. This national level faculty development program, organized by the Postgraduate Department of Commerce, is going to get its spirit through the words of our honorable resource person, Mr. C.A. Amal Paul. To speak about him, C.A. Amal Paul, partner Sebastian and Paul, Chartered Accountants, Kochi. He served as article assistant and audit manager of Babu A. Kalivalil and co-chartered accountants. He is still serving as a teaching faculty for CA Final, CA Inter, CMA Foundation, CMA Inter, and CMA Final in various institutions such as Teacher Bro, Trivandrum, Kozhikode, and Ernakulam branch of SIRC of ICAI, Marine College, Kudekanam, IAT Professional Campus, Kottarakara, Learn Cap, Our Learning Academy, Ernakulam, and so on. So with great pleasure, I welcome you to handle the session.
Okay, thank you for that welcome. Okay, so let us move on to the session. So today my topic is IFRS Converged into AS need and its major changes. So that is the topic on which I'm talking today. So I'm privileged to have a session like this because uh, I'm just a person who is 24 years old, but I got the opportunity to train the faculties since from 2019 onwards. I got an opportunity to teach the state level, to lead a state level workshop at Nirmala College, Muattura. And again, I got an opportunity to train the faculties on in-days aspects for a 5 days program at Marine College, Kudiganam. And this is my third faculty development program that is being conducted in association with various branches of SARC of ICA. So basically, today's topic, I'll be briefing about three types of standards we are having. One is the normal accounting standards which we are having. Second one, there is a new set of standard which is there in India from 2015 onwards, that is Indian accounting standards. And there is a set of standard which is applicable worldwide, that is IFRS, International Financial Reporting Standards. So why India had gone for this in the form of Ind AS? What is the difference between this Ind AS and AS? All those things we'll discuss with within a span of 1 hour. That is what we plan to do. So if you check this, whatever things I'm going to discuss today is with respect to accounting standards. So first, we will discuss about accounting standards. What is accounting standard? What is its objectives? And how these international standards are formulated? And what are the components of those international standards? Then we will move on to the need for this Ind AS in India and what are the major changes happened here. So firstly, if you check the meaning of accounting standards, this meaning of accounting standard is coined by Institute of Chartered Accountants of India. They had issued a document known as Preface to the Statement of Accounting Standards in 1978. So that document contains this particular definition for accounting standards. This comprehensively covers what is the meaning of accounting standard. So basically, when it comes to accounting standards, we all think that it is a dry area, it is a theory area within accounting, why we should learn this and all. But frankly speaking, I would say that this accounting standard is the lifeblood of our accounting itself. Because whenever we are having a doubt in accounting for any item, whenever we want to frame an accounting policy for a company, whenever we are preparing a financial statements in practical sense, we are required to check these standards. We are required to follow these standards. If it is not followed, that is having some penal provisions in Companies Act itself, in this 2013 Act and all. So likewise, it is having a lot of significance. So first, we will understand what is the meaning of this accounting standards. So accounting standards refers to certain specific written policy document. These are being issued by government with the support of some regulatory authorities such as ICAI. Okay, so this is the it is a policy document. It is not a rule. It is not a thing which is to be followed verbatim. It is a policy document which deals with these four aspects with respect to accounting transactions and events. That is, while we are reporting, while we are preparing financial statements, this policy document, this accounting standards gives guidance with respect to recognition, measurement, presentation, and disclosure aspects of different type of accounting transactions and events. So before moving on to this definition, first we will discuss what are the meaning of these four terms. So accounting standards will be covering these four aspects while we are accounting transactions and events in the financial statements. So basically, this first aspect which is dealt with by the accounting standard is recognition aspects. So recognition simply means when we should record this transaction, when we should record this transaction, or when we should include that item in the books. That is what your recognition aspect means. Secondly, the measurement aspect means at which value we should record this. This may be at the time of entering into this transaction. So that is known as initial measurement. And it may be at balance sheet date. That is known as subsequent measurement. Likewise, measurement can be of two types. It may be an initial recognition, that is when this transaction occurred. And secondly, at balance sheet date, that is known as subsequent measurement. This is also subject matter of the standard. Thirdly, it deals with presentation aspects. That is, how should it be presented? How should it be presented in the financial statement? That is, if it is an asset, where we should show this. If it is a liability, where we should show this. Whether it should be netted off with one item or whether it should be shown on a gross basis. Likewise, how this is to be taken to the balance sheet and P&L while preparing the financial statements. That is your presentation aspects. Lastly, it deals with the disclosure aspects. That is, these are some additional information we should provide in the financial statement to increase the understandability of financial statements. We know that the financial statements are having certain qualitative characteristics. It required to have certain qualitative characteristics. First one is it should be reliable, it should be relevant, it should be understandable, and it should be comparable. So basically, in order to increase the understandability, to increase the reliability of financial information, sometimes we are required to give some additional information in the financial statements with respect to certain transactions and events that are known as disclosure aspects. So if you comprehensively look at all these points, accounting standards is nothing but it is a policy document which states when we should record a transaction, at which value it should be recorded in the books, and at which value it should be recorded in the financial statements, and how it is to be presented in the financial statements, and what all additional information need to be provided with respect to those transactions and events in this with respect to this transaction or event. So that is the meaning of accounting standard. So it comprehensively covers how we should account for an item, how we should report an item. So why this accounting standard had introduced? So if we check the evolution of accounting, we all know that this accounting we follow is the double entry system of bookkeeping, which had started in the 15th century only. That is an Italian mathematician known as Luca Pacioli. He had written a book on the double entry system of bookkeeping. So at that time, what happened is that we were having a small type of entities such as partnerships or the sole proprietorships and all. So the basic idea with respect to the framework he had made was how we should ascertain the profit or loss for a particular organization, particular entity. But eventually what happens is that in the 18th century, 19th century, we had this modernization, industrialization and all. So we had moved our production techniques from the labor intensive techniques to capital intensive techniques. So what happened is that a new form of business organization had evolved. That is known as company form of business organization. So company form of business organization has different peculiar features like it is having limited liability, it is having perpetual succession, it is having a common seal, it is a separate legal entity. Likewise, certain features are there. In that, one point is crucial when it comes to the accounting perspective. That is, its ownership and management is different, it is segregated. The real owners of a company is the shareholders, whereas it is being managed by the board of directors. So this has created a wide range of opportunity for accounting. This has increased the importance of accounting, because earlier, when we are running a sole proprietorship, we know we are using our funds. We just wanted to know what is our profit or loss. But now, when it comes to a company form of business organization, what happened is that the shareholders are entrusting their money to the board of directors, and they are managing the funds. They have to know two things. One, whether their funds are managed properly. Secondly, what is their profit or loss? So these two aspects need to be looked into by a shareholder. So at that point, the entities had understood, the shareholders had understood, the stakeholders had understood one point. That is, there are various accounting treatments, there are various type of methodologies which we can see in accounting. For example, for the inventory valuation itself, we had the FIFO method, we had the weighted average method, we had the simple average method, we had the LIFO, last in first out method. Likewise, numerous methods are available. So due to this difference, will not be in a position to compare the results of one particular company with another. So as far as a shareholder is concerned, he is required to analyze whether his funds are managed properly. So what he can do for that, he can compare the results of this particular company with the other entities. Okay. Likewise, he can check the results of this particular year with the prior years. That is what he can do. So then they understood that this is not possible due to various type of accounting treatments, various types of methodologies, various types of principles they are following. So they had the certain countries had a view, that is, they have to form something known as accounting standards. That is how this accounting standards or IFRS or Ind AS, all those kind of standards are evolved. So basically, these standards are having two basic objectives. Whatever be the accounting standards we are learning, these are having two different objectives. One, eliminate the non-comparability between the financial statements and thereby improving the reliability of financial statements. Secondly, we should provide a set of standard accounting policies, valuation norms, and disclosure requirements. So when these two objectives are met, if these two objectives are met, all those four qualitative characteristics of financial statements can be achieved. That is the ideology. So that is why this accounting standard had framed, and that is getting implemented. So if you check this accounting standard had evolved in at international level. Okay, so first we have to check how this is evolved. So in 1970s, there are certain countries in the European Union, that is like Britain or certain countries. They had around 15 countries. They had formed a group to standardize this accounting methodologies and all. So they had started publishing some journals and all, and this has got some positive feedbacks from across the industry. So they started to think like we have to frame some standards which can be applied globally, So consequent to that idea, certain countries like Austria, Britain, or US, and all, they had formed a committee known as International Accounting Standards Committee. So that had happened in June 1973. Subsequently, what happened is that, so their committee's name was International Accounting Standards Committee. So they had started to issue standards. So in Jan 1975, they had came up with their first standard, that is IAS 1 on disclosure of accounting policies. Subsequently, the standard had got renamed and all. That doesn't matter. But their first standard was IAS 1 disclosure of accounting policies. Now it is known as IAS 1 presentation of financial statements. They had renamed it subsequently. So this was their first standard. And what they had done is that they had requested all countries in the world to follow this standard. So at that time, two major accounting bodies, that is one ICA and one AICPA, they were also required to respond to this query, what we should do. So when they approach this US, they are the persons who are behind this body itself, but they were reluctant to implement this IA standards in their countries. They state that they will prepare and follow their own standards. They had set up a separate body known as FASB, Financial Accounting Standards Board. Likewise, they had set up a body and they had started with those standards. And when it comes to India, IC also said that we are not a country which are doing global trade as on date, because it is in 1973 and all. We had not opened up our economy and all. So our India had stated that ours is a closed economy. So what we will do is that we are a permanent member of IFAC, International Federation of Accountants. We do accept that fact. We are required to encourage the global pronouncements also. So what we'll do is that we will frame a body known as ASB of ICA in India, and we will evaluate whether we can implement your standards, and we will issue standards based on that in India. So if something is not required, we will not implement that. We will review each of those items. We will analyze. We will also make some changes, and we will implement that in the way of AS. So that is what our India had also stated. So gradually, many countries had started following this international standards and all. And in 1999 and 2000, they felt that more and more countries are joining in this forum. So it requires a reconstitution. It requires a reconstitution. And they had framed a body known as International Accounting Standards Board. They had reconstituted IASC and they had renamed it as IASB. So when this IASB had came into force, they state that we should not merely focus on the accounting perspective. We should focus on the financial reporting and all. Our duty will not end while accounting. We should prepare the financial statements, how an item should be presented in the financial statements, that should be given more importance. So this IASB said that whatever be the standards we will be issuing, those standards will not be in IAS series. We will form a new series known as IFRS series. So consequently, in June 2003, this IASB had started issuing their standards. Their first standard was IFRS 1, first time adoption of IFRS. But what they had done is that whatever the pronouncements that were made by IASC, that they had kept there. So when some points in that standards is not relevant now, or it is required to be replaced, they are just withdrawing those standards and issuing a new IFRS. They had said that they will adopt all the standards issued by IASC, and whenever a new standard is required, old standard from IAS will be deleted and a new standard under IFRS will get implemented. So likewise, if you check till 2001, till 2001, this IAS set of standards had 1 to 41 standards, out of which 24 standards are there in force as on the state. And in IFRS also, IFRS 1 to 17 is there, out of which 16 standards are there in force. So totally, we are having 40 IFRS standards. So IFRS, when we say that name, it includes both this IAS series standards as well as IFRS series standards. So that is the global position we are having. So if you check this IFRS, what they state about this IFRS is that it is a single set, high quality, easily understandable, enforceable, and globally accepted financial reporting standards based upon clearly articulated principles. We are having a load of accounting principles like materiality, substance over form, fair value, prudence, and all those kind of principles we are having. So, based on those principles, how we should do the accounting, how we should do the financial reporting, that is what this IFRS is talking is speaking to us. So it is a principle based set of standards which are easy to understand and apply. So if we check this IFRS, it is having 5 different components. First one, there is a basic document known as conceptual framework. So this conceptual framework is nothing but it is a basic document which states that what are the components of financial statements, what is the objective of preparing financial statements, and who are the users of financial statements, what are the qualitative characteristics of financial statements, what are the underlying assumptions while we are preparing the financials, then what are the elements of financial statements like assets, liabilities, capital, income, expense, what is its definition, what are the recognition principles for that, what are the different measurement bases we are having, how to maintain capital. Likewise, it is a very basic document which sets out the entire framework under which this IFRS standard need to be issued. So this framework is a principal document within which the standard needs to be framed. So that is first document in IFRS. And secondly, we are having this IAS standards which are issued by IASC, which are being adopted by IASB. There are 24 standards in force, as I said earlier. Their name starts from IAS 1 to IAS 41. IAS 1, presentation of financial statements, and it is goes on till IAS 41 on agriculture. Then there is a third component, which is known as SIC interpretations. SIC interpretations is nothing but what these are the interpretations given to the IAS standards. So there is a committee known as Standing Interpretation Committee under IASC, which issues the interpretations for this IAS standards. And fourth component, we are having this International Financial Reporting Standards itself, that those standards named in that name itself. So we are having 16 standards, which is from IAS 1 to IFRS 1 to 17, out of which IFRS 4 on insurance contract were withdrawn and IFRS 17 on insurance contract had implemented. That is not yet made it mandatory. That is still IFRS 4 can be followed, but its mandatory application starts from 1/1/2023 only. So simultaneously, there will be one standard out of these two will be applicable. So if you check fifth component, there are certain interpretations issued for these standards also, that is known as IFRIC interpretations. So likewise, this entire 5 components are there. This 5 components put together is known as IFRS. It is not a single set of standards. It consists of 5 different components. That is your IFRS. And we will also see what is the position in India. We said that in 1973, when this IEAC had approached India, India said that we will frame our own standards because ours is a closed economy. But so consequent to that, in April 1977, Accounting Standards Board of IC had been formed, And they had issued a standard known as AS1 disclosure of accounting policies in India in 1979. So what they had done is that they had evaluated the global standards, and based on that, if it is required in India, they had framed our own standards. But certain changes we had not implemented. For example, this IAS1 had replaced by IAS1 presentation of financial statements. But in India, it continues to have a disclosure of accounting policies. Till now, it is only disclosure of accounting policies. That standard had not got revised in line with international standards. And gradually, what happened is that in 1991, India had opened up our economy, and cross-border transactions are all had started happening. So at that time, India had also started to face some issues. Even though we had made this accounting standards compulsory, and we had notified the company's accounting standard rules 2006 and made this is compulsorily applicable to companies and all. What happened is that certain international developments we had not followed, we had not implemented in India in the form of accounting standard. But at international level, different treatments were coming up that were not implemented in India, since India had thought that it is not required. Okay, so we will take a scenario where some practical difficulties had arose. One is that our own Indian company, Tata, had acquired Jaguar way back in 10 or 15 years back. So then what happened is that Tata is a Indian company and Jaguar is I think it is a German company or something. So these two companies had joined together. So at that point, Tata's accounts was prepared using AS, whereas this Jaguar's accounts were maintained in IFRS. So both the standards, AS14 as well as IFRS 3, both these standards states that while you are going with the accounting for this accounting amalgamation or business combination, you have to first make your accounting policies uniform, your accounting basis uniform. Then only you can start accounting. So they are using two different bases. So how they can do this accounting? So Tata had requested SEBI to notify that Indian companies who are listed can follow IFRS also. Likewise, they had made a request and SEBI had agreed for that. And Tata had gone to IFRS and then they had done the Jaguar acquisition accounting. Likewise, certain practical difficulties had started. And when this economy has opened up, so the a person who is sitting in US or UK, if they say if they see the financial statements prepared for an Indian company, this it states that it is prepared in accordance with accounting standards. They do not know whether this accounting standards and IFRS and one and the same, whether the accounting methodology followed by them is correct or not. So likewise, certain practical difficulties had came into picture. So what India had done is that, okay, India had also understood the need to go with IFRS. So in 2006, they had started this process. So when they had started this process, they were having two options. So in order to implement IFRS in India, there are two options. Either we can go with adoption route. That is, there is IAS standards, IFRS standards, which are issued by IASB or IASC. We can simply say that we are following IFRS. Whatever been issued by IASB, we will follow that. That is your adoption route. Second route is convergence route. That is, we will frame a set of standards which is in line with IFRS. We will be making small changes, but the principles, practices, it will be largely aligned with IFRS so that it will increase the confidence of the investors. In IFRS Foundation's website, they will show that this country had implemented IFRS, so the investors can trust them. Likewise, they'll also show in their website. So that is the second route, convergence route. So when India had started discussing about implementation, this IFRS, when it comes to this IFRS, what happens is that it is framed by certain developed countries and all. So the that aspect we can see in many places. Some economic conditions, due to certain economic conditions, those provisions, certain provisions may not be ideal for us. And if you check the Indian scenario, our law and this accounting framework both is aligned that much. And our taxation system is also aligned with this. So we cannot simply go with IFRS. So we have to check whether this can be implemented in India or not. Likewise, we have to make some evaluations and all. So India thought that we can go with a convergence route. That is the reason why India had not adopted IFRS per se, but India had framed a new set of standard, which is known as INT AS, which is known as INT AS, Indian Accounting Standards. So when framing this INT AS, their idea was we have to implement IFRS. We have to increase the confidence of the shareholders, stakeholders, the investors. So we should make only minimum changes. We will make changes only if there is a absolute necessity. So that is how this IAS, ASB of ICA had considered this, and they had took the standards. So when they took the standards, they were having some difficulties. That is, if you check this IFRS, there is IA standards 1 to 41, as well as IFRS 1 to 16, 17 also. 17 is not at mandatorily applicable. So for the time being, I will say that it is 16. So, well, when we are framing the standard, there is IAS 1, there is also IFRS 1. Okay, there is also IFRS 1. We cannot name India as 1 for 1, and again we cannot use that number. So what India had done is that for this IA series standards, we thought we can give India as 1 to 41. That numbering itself we can give. And for this IFRS series, we can start with 100 series. That is, for IFRS 1, we can number it as Ind AS 101. IFRS 2, Ind AS 102. Likewise, 100 series we can follow. So they had framed this IFRS. When they had framed 23 Ind AS in 123 series had framed. One standard was there, IAS 26, that was applicable to non-corporates only. In India, as of now, it is applicable for corporate. So they had kept this IAS 24 outside and took all other standards. So that is why there is only 23. And they had also framed 16 standards in IFRS series. So put together 39 Ind AS is there. Put together 39 Ind AS is there. So likewise, India had framed a new set of standards which are converged with IFRS to improve the transparency in accounting and harmonize the accounting standards currently being used with global standards. So we had named and numbered it in the same way as corresponding IFRS. That is, IAS 1 to 41 is numbered as Ind AS 1 to 41. IFRS 1 to 16 is numbered as Ind AS 101 to 116. This is how we had named and numbered these standards. And even the paragraph numbering, we had made it same so that we can implement this properly. Any entity can prepare this properly. So we had taken all this. And there were certain interpretations like SIC interpretations or IFRS interpretations. Those we had added as appendix to each standards. And in addition to that, we had given a separate appendix in this Ind AS that which talks about what are the differences between this particular Ind AS with that of corresponding IFRS. What is the difference? That comparison also they had given so that anybody can understand what we had done in Ind AS. So that is how the standard is formulated, and this is notified in 2015 through companies Indian Accounting Standard Rules, Companies Indian Accounting Standard Rules 2015. So that is the standard. That is the rule through which it is made applicable, and it is now applicable for companies only. It is not applicable for entire companies. It is applicable for some larger companies only. Smaller companies, they can follow that on a voluntary basis. For some larger companies only, this are made applicable. For smaller companies, they continued with our old standards. We are having AS 1 to 29, out of which 27 standards are enforced. AS 6 on depreciation accounting, AS 8 on research and development, these were withdrawn. And we are having 27 AS as of now. So that is applicable for smaller companies. So that is notified through Companies Accounting Standard Rules 2021. And what is applicable for larger companies is Companies Indian Accounting Standard Rules 2015. So first we have to understand who are required to follow this Ind AS. So if you check this voluntary adoption, any company, okay, only company can go for voluntary adoption. Any company other than banking company, NBFC, insurance company, they can follow this Ind AS voluntarily. And today I'm taking the today's position. There was a roadmap. I'm not talking about that roadmap. I'm just emphasizing on who are required to follow this Ind AS today. So that is listed companies other than banking and insurance. So normal companies and NBFCs both put together. NBFCs listed normal companies, listed NBFCs, two parties. Then unlisted companies other than banking and insurance with net worth of 250 crore or more. That is, normal unlisted companies having net worth of 250 crore or more, and unlisted NBFCs with net worth of 250 crore or more. Both these entities are required to follow Ind AS. And apart from that, holding company, subsidiary company, associate, and joint venture of above companies, or these companies are also required to follow Ind AS as on the date. All other companies, that is unlisted NBFCs having net worth less than 250 crores, unlisted companies, normal companies having net worth less than 250 crores, banking company, insurance company, all these are under AS framework only. Ind AS is applicable for other companies. So for banking, RBI had said that they'll implement that from 2018 onwards, but they had deferred it indefinitely. Insurance companies, they state that when IFRS 17 is globally applicable, then you ask us to follow, then we will follow. That is the stand of IRBI. So they'll be framing their own roadmap subsequently. But as of now, these companies are required to follow Ind AS. And next, we have to see what is the difference between this Ind AS and IFRS. That is, when we had made this transition from IFRS, when we had made these changes from IFRS, what are the changes we had made while framing this Ind AS? So these changes we can classify into two buckets. One is known as changes which results in carve-in or carve-out. So changes which results in carve-in or carve-out is nothing but these are some changes. Carve-in means something is added new. Carve-out means some existing provision is amended. So both this will become a non-compliance with IFRS. So IFRS gives a treatment. We are giving another treatment in Ind AS. Those changes are known as changes which results in carve-in or carve-out. For example, we can take an example with respect to business combination. So we are having accounting standard 14. We are having accounting standard 14 on amalgamation, which states that, for example, we had given a consideration of 150 rupees to acquire a company whose net assets is 130. We will account it as a goodwill, right? We will account it as a goodwill. And if we had given a consideration of 100 to acquire a company with net asset of 130, this difference, 30 rupees, this gain, we will account it as capital reserve. This is the position we are seeing in accounting standard 14. And we are having IFRS 3, which is the corresponding standard for AS 14. IFRS 3, this is on business combination. They state that if your consideration is 150 and your net assets is 130, then this difference you can very well treat it as goodwill, no issue. And if your consideration is 100 and you are getting a net asset of 130, in this scenario, you are required to take it to P&L. This is what this IFRS 3 states. They call it as bargain purchase gain, and this need to be taken to P&L. But when we had analyzed the Indian scenario, if we take this to P&L, what happens is that for Ind AS compliant companies alone, this can be taken to P&L. This will become form part of your distributable profit. But for AS companies, it will be capital reserve. It will not form part of distributable profit. It will give rise to a lot of litigations and all. And again, it is not a realized profit also. So it will be ideal to book it in under the capital reserve only. So while we are framing in the AS 103, what we have done is that we said that goodwill, that is fine. When it comes to this item, this will not be taken to P&L. This is to be taken to capital reserve. So likewise, we had made an amendment. So this is Ind AS says that you have to take this gain to capital reserve. IFRS says that you have to take it to P&L. So the treatment differs from what is set out in IFRS. So these kind of differences are known as changes which results in carve-in or carve-out. There are 10 major carve-outs which we can see, and one carve-in that also happened to this IFRS 3 on business combination. They exclude some transaction known as common control transaction, but in Ind AS we had excluded it from the normal treatment. We had given a separate accounting treatment for that. That is one carve-in we are having. So that is your changes which results in carve-in or carve-out. Second type of difference which we can see is that changes which does not result in carve-in or carve-out. Changes which does not result in carve-in or carve-out. That means it is not a non-compliance. We had made some changes, but it is not in violation of this IFRS. That is, if you checked your cash flow statement, standard on cash flow statement, okay. So usually in India, what we'll do is that the dividend paid, accounting standard 3 states that we have to take this to financing activities. We have to take this to financing activities. Whereas IAS 7 on statement of cash flow states that you can either show it in operating activity or you can show it in financing activity. When we had framed this Ind AS 7, we state that you can follow this financing activities only. You have no choice to show it under operating activity. So we are having an existing practice. IAS was giving one more option. We had removed this option and we had made this to financing activity only. So if we show it under financing activity also, that provision is there in IAS. So that is in compliance with IFRS itself. So likewise, we had made a change in IFRS. We had made a change in this Ind AS, but it does not result in a change with non-compliance with IFRS. For example, in IFRS, they use the term statement of financial position, but in India, we only call it as balance sheet. So we had replaced that word with balance sheet. Okay. Likewise, some nomenclature changes are there, or some removal of options is there. That is known as changes which results in changes which does not result in carve-in or carve-out. So effectively, both this put together. That is, if you check what is this Ind AS, it is nothing but IFRS minus carve-out plus carve-in plus or minus some option removals, nomenclature changes, we will get Ind AS. Effectively, around 99% of the standard is same as IFRS. Only few differences we can see. So that is your Ind AS versus IFRS analysis. And if you check this AS versus Ind AS, what is the difference? We only know this AS. We only heard about this AS, right? So what is the difference between AS and Ind AS or IFRS? So this nomenclature changes means a change in terminology, Jolsna. some terms like statement of financial position, it is changed to balance sheet. Statement of comprehensive income, they changed it to statement of P&L. So that nomenclature change means change in terminology only. Then difference between AS and Ind AS. So if you check this difference between AS and Ind AS, first, Ind AS is more principle based, whereas AS has some rule based approach. For example, if we check the accounting standards, goodwill, we are having an item known as goodwill when we are acquiring a company. Okay, so in accounting for amalgamation, AS 14 states that goodwill that need to be amortized over a period of 5 years. Okay, that need to be amortized over a period of 5 years. Whereas when it comes to IFRS 3 or Ind AS 3, they does not say that you have to amortize it. They say that it is we cannot identify what is the actual useful life for goodwill. It is indefinite. We cannot say that it is 5 year or 7 year or 9 year or 10 year. Likewise, we cannot say. So they say that since its useful life cannot be understood, we have to we should not amortize it, but we have to do an impairment test on an annual basis. That is, whether it is value had decreased or not, we have to make a test based on IAS 36 or Ind AS 36. There are provisions for that. You do that. So that is what Ind AS says or IFRS says. Likewise, even though AS is also principle based, in some area we were having some rules, but when it comes to Ind AS, it is more principle based. That is one difference between your AS and Ind AS. Secondly, if we check this Ind AS, this gives more focus on substance over form concept. So basically, in AS also we are having this substance over form concept, because if you check the accounting standard 9, the standard does not say that your ownership of asset need to be transferred, ownership of good need to be transferred to the buyer. They only state that significant risk and reward incident to ownership need to be transferred. So that is an application of substance over form concept. Or when it comes to AS 19, they state that leases, we have to identify what is their nature, whether it is a finance lease or operating lease. Based on that, we will account for that. Okay, likewise, we were having the element of substance over form concept in AS also. But when it comes to Ind AS, they are giving more emphasis to this substance over form concept. Let us take a small example with respect to that. In AS framework, the preference share capital, we will always show us share capital, shareholders fund. But you just think from the accounting perspective, or you just from the practical perspective, whether they are actual owners, whether they are actual shareholders. The answer is no, because they do not have shareholding unless they are affected by that decision. They are having a fixed dividend. They'll not get any additional amount unless it is participating in nature. They'll get back their money after some period. So if you check a case of non participating cumulative redeemable preference shares, it is as good as a debenture. If you are having a non-convertible, non-participating, redeemable, cumulative preference shares, it is as good as a debt. Today says that if that is the scenario, you should show those kind of preference shares in borrowings only. But if it is having the nature of equity, then only you should take it to equity. Likewise, they're giving more relevance to the substance over form concept. That is the second difference between this AS and Ind AS. Thirdly, it gives more focus towards fair value. For example, they are having a separate standard for fair value measurement itself. Ind AS 113 on fair value measurement, or IFRS 13 on fair value measurement. And if you check this IFRS 3 or Ind AS 103 on business combination, that standard states that when you are acquiring another business, all assets, all liabilities of that company, that entity need to be taken over at fair value. Or when you are classifying one asset as held for sale, they state that you should show it at lower of its carrying amount and fair value as cost of disposal. And if you check this various standards, if you check this IFRS 9, that states that financial assets, financial liabilities, we have to show them at fair value. So likewise, they are giving more emphasis to fair value. That is the next difference between this AS and Ind AS. And another difference is that Ind AS is having a large disclosure requirements, because when it comes to IFRS, one of the objective of this IFRS is that they have to bring transparency in financial reporting. They have to bring transparency in financial reporting. So, in order to bring this transparency in financial reporting, they had stated that you have to give an extensive disclosure. Then, apart from that, Ind AS is more principle based. So when it comes to this principle based standards, what happens is that more assumptions are required, more judgments are required. So all these give rise to increased disclosure requirements in Ind AS. So if we check the differences between AS one by one AS and Ind AS one by one, you can club these differences into any one of these four buckets. Apart from that, you will not get any other difference. So that is what we can see the different as the difference of AS and Ind AS. So as a conclusion, what we can say is that IFRS is the standard which is being followed globally. So that standard now they have it is being implemented in more than 140 jurisdictions. So India had also felt a need to implement that, so they had implemented that in the form of something known as int AS. Secondly, this int AS that is applicable for larger companies only. Non-corporates are not required to follow that. It is applicable for some large companies known as listed companies, unlisted companies having net worth of 250 crores and more or more, and their group companies. And thirdly, the standard is more focused on principle based things. It gives more relevance to substance over form concept. It gives more relevance to fair value concept. It gives more disclosure requirements and all. And when we are framing the standard, we have made very minimal changes to Ind AS, and so that will give rise to uh, increase the confidence of the global investors. And if you check the AS and Ind AS also, largely 60 to 70 percentage content of both the standards are one and the same. Because initially, if you remember what I had said in the initial stage, our existing AS was based on the IA standards itself. We had not done some updations, but the basic principle we took from those standards only. So largely 60 to 70% this content is one and the same, but there is certain standards which are having significant difference. So one is with respect to amalgamation. In the AS 103 on business combination, that is having a significant difference between your AS 14. Second one is that financial instruments, how we would account for this preference shares, investments, this loans, borrowings, those kind of items, all those financial monetary contracts, how we should account for that. It is having a significant difference. Thirdly, there is a revenue recognition standard in the AS 115 on revenue from contracts with customers. It is also having a significant difference between our older AS. And lastly, in the AS 116 on leases, that is also having some significant difference between our existing AS. Apart from that, all most of the other standards are largely aligned with the international standards itself. So if you know the normal AS, it will be easy for you to understand this in the AS. It is not a thing which you cannot study. It is not a thing which is that much difficult. So I'm a person who had written my CA final exams by studying AS. And within a span of 1 year, I had taken classes for Ind AS for CA final students as well as for members. So that is the way in which I had groomed myself. So you will also be able to study AS if you know Ind AS sorry, if you can will be able to study Ind AS if you know the AS concepts. So this is what I just wanted to convey to you. And if you are having any queries, you can put it on the chat box, or you can ask those queries. And that's it. Any queries?
Now it's time for you, dear listeners. If you have any queries to our beloved resource person, you can free to ask and to make this session interactive. So if any queries, please.
Sir, I am the faculty in the Department of Commerce, Dr. Matthew Manuel.
Okay.
So I just start this interactive session for further motivation of asking questions by students and other participants. Dear sir, you have performed an excellent presentation here. But with regard to the multinational companies,
yes,
there is a dilemma because it deals different nations, community of nations. So Australian accounting standards, that is somewhat different, at least in nomenclature also, as you said in your lecture, with European Union, as also with Britain and USA or other countries. So how these kind of big daddies or multinational companies deal with these IFRS, whether they follow a uniform pattern, that I think they cannot, because they are diverse, dealing with different nations. So they are compelled to follow different standards. As you said earlier, the standards that came into the year 1970, before that also it is known as the principles. Up to 1969, the accounting principles that has dramatically changed the nomenclature into standards. And you also well defined, it is the written statement by government with the support of statutory bodies like ICAI, etc. So anyway, that is one important query from my part. Another one minor question is relating to the AS and Ind AS. Whether the forest accounting is blended with agriculture, that is accounting standard 41, the last one. So that also I want to clarify this, because farm accounting and other things are now incorporated even in the BCom syllabus. Another thing is that accounting standard 7, the cash flow statement. But in the Ind AS, there is the removal of the statement itself, only cash flow. So what is the logic behind this? These are the three queries I desire to share in this August audience.
Okay, thank you, sir. That was a wonderful query. So first, I'll go in that order itself. First, you had asked a query on this multinational companies. So basically, what happens is that if there is a multinational company, what is their country of origin? That is the country in which they have to file their returns, their forms, and all. For example, there is a Tata Motors in India. They are having worldwide operations, but they have to file all forms, all things with India. Likewise, if there is a foreign branch of another company is having a foreign branch in India, then they are also required to comply with the taxation laws and certain things of this particular country also. So there are a lot of legal frameworks applicable for them. So that is a fact. So, but what happens is that when it comes to this accounting framework, currently more than 140 countries had gone with this IFRS. Either they had adopted this verbatim, or they had gone with this convergence route. So largely in many of the countries, this IFRS is what is getting implemented. So earlier, if there was a country in India, we'll take the example of Tata Motors itself. So what Tata Motors was doing is that for taxation purpose, for company filing purpose, they were maintaining a separate books under AS framework, and they were also maintaining a separate books under IFRS for the purpose of their uh, group financial reporting and all. So that was the situation with respect to Tata Motors at that point of time. So, but when this Ind AS has got implemented, they are following only Ind AS, and they are making changes. They look into the carve in or carve out whether there is any effect for this carve in or carve out in this accounts. They'll make a modification for that, and they will present their group reports in IFRS. So that is how that they are doing now. So likewise, if you check the Australia, they are following this IFRS per se. And if you check the European Union, they are following this IFRS per se. If you check the England and Wales, they are also following this IFRS. US, they are following US GAAP. So only few countries are having their own gap as of now. If their gap is getting used, what happens is that dual accounting comes into picture. They have to prepare one financials under IFRS and another financials under their respective gap. So that is what happens to MNCs. Thankfully, in India, we had implemented this IFRS. So currently in India, this is not a Herculean task. Only 10 major carve-in or carve-out are there. That is having a small impact when we are transferring it to IFRS. So likewise, other countries also, this is largely aligned with IFRS. So currently, it is in a good position. So that is the case with respect to multinational companies. They are if the framework is different, they have to maintain two books. They have to maintain two statements. That is for sure. So that is the query for first thing. I think it is fine, right, sir? Okay. Secondly, with respect to agricultural standard, we are having Ind AS 41 on agriculture or IAS 41 on agriculture. They state that if there is a biological transformation, that is growth, degeneration, all those things happens, and we are managing that activity, that is agricultural activity. They do not say that they do not restrict the agriculture to farming itself. They do not restrict it to just growing some plants. They say that if we are conducting and managing a biological transformation of any biological asset, any living animal or living plant, then it is an agricultural activity. And if you are having any biological asset and you are having agricultural produce from that, and if you're getting any government grant for those agricultural activity, so that is to be accounted based on this IAS 1 or Ind AS 41. Sorry, IAS 41 or Ind AS 41. So basically, if we are managing the forest products also, we are managing that. Okay, we are having some, for example, we are having bees, honey bees. So if we are having that, we are taking that honey from there, from the forest, the standard may get applicable because we're managing some agricultural activity, some likewise. So this agriculture standard may become applicable there. So that is how it is to be checked, if whether we are having this agricultural activity or not. But if it is not agricultural activity, you are just taking this forest products only, then it will not be covered under IAS 41. So what happens is that at Indian level, we are having some monographs issued by ICA and all. So in that, some provisions is made, and what the standard states that if if you check the Ind AS 8 or IAS 8, while you are framing the accounting policies, if no specific standard is there, you have to check similar whether similar standards is there. Okay, so if you are having this forest products and all, it is largely similar to this agricultural activity itself. The agricultural produce we get from forest, agricultural produce we get from this agricultural activity. Both will be forest products, agricultural produce. This will be similar in nature, some cases. So in that case, what we can do is that by checking the provisions in this IAS 41 or Ind AS 41, we can frame the accounting policy for this particular item. If a similar standard is not available, they state that you should look into the framework: asset, liability, capital, income, expense, definitions given, recognition principles given for that in the framework for preparation of financial statements. Based on that, you have to apply your mind, your judgment, and you have to prepare an accounting policy for that. And if you're not getting answer from there also, you just check the pronouncements of recent pronouncements of IASB or similar bodies which are using IASB's reporting framework, whether they had given any clarifications on that. That is what they asked us to check. And lastly, only we can go with the industrial practices. So likewise, we have to go into a sequence, and we have to follow the guidelines. So if you check this forest products, largely we can follow the principles of IAS 41 or Ind AS 41 by complying with this provision contained in IAS 8 or Ind AS 8. So that is the query for second one. And thirdly, for cash flows. So if you check this AS3 on cash flow statement, we are having a corresponding standard in the 7 on statement of cash flows. Okay, so this nomenclature only changed. All the provisions that is there in AS3, that is ditto same in AS3, in AS7 or IAS7. So no worries about that. Both are one and the same only. So these are the sir. Your audio is mute. Is it clear, sir?
Yes, sir. Okay, thank you so much.
Okay. Then I had got another query from Jolsna, that is whether IFRS is not fully implemented and why. So I think I just had given this reason while I had made my presentation itself. That is when it comes to IFRS is a principle-based set of standards that is made globally. So it is framed by some developed countries per se. So some of the requirements that is contained in this IFRS may not be suitable for a country like India. That is, it is a developing country only. Certain provisions may not be suitable for India. And secondly, our legal framework and our accounting framework is largely interdependent. So if we are per se following IAS standards or IFRS standards, we'll be having a lot of confusions, a lot of issues when it comes to this also. So that is the reason why India stated that we will not follow this IFRS per se. We will go with the convergence route only. We will review the entire standards. If there is any modification that is required, that is required for sure, then we will make those changes. So that is what they state. So that is why India had gone with this convergence route. Is it clear, Jolsna? I think she's not here. Okay, so any other queries? Any other queries?
Okay, sir, we can move to the next session. Thank you so much, Samal sir, for being with us. So as a token of love, Postgraduate Department of Commerce of the College like to share with you a certificate of appreciation. So I invite Ms. Anu Anthony, ma'am, NAC and IQAC coordinator, to hand off the certificate virtually. The feedback form is shared in the link. Please fill the same. Those who attend the program for all the 5 days will be eligible for the certificates. Moving on to the concluding part of today's event, it's time to express the words of gratitude to all of you gathered here. I would like to invite Mr. Justin Joseph, Student Coordinator, to extend the words of gratitude.
Good evening to one and all. Life gets redeemed when our hearts lift up in gratitude for whatever we have here in life, and also when we show enough thankfulness to those who are instrumental in enlightening us with happiness, prosperity, and contentment. One of the hallmarks of this faculty development program is the overwhelming participation from people across the globe. The responsibility entrusted upon me today is to express my gratitude towards all the eminent dignitaries present on this virtual platform. Let me first of all start by giving glory to the Almighty God for making today's event a resounding success. Reverend Father Joshi Chiranguri CMI, Principal of Christjodi College of Management and Technology, is an epitome of charismatic personality and the person who has holistic outlook towards life. With all my heart, I express my sincere gratitude to you, dear Father. C.A. Amal Paul, the keynote speaker, is a personality with intellectual caliber, academic credentials, and oozing confidence. The talk he showered upon us had all the ingredients of wit, wisdom, foresight, and ample vibrancy. I express my gratitude to you, sir, for being part of this great endeavor. Dr. Varghese Anthony, Vice Principal of Christjodi College of Management and Technology, is an academician of great repute and immense value. Through his warm, deep understanding and cooperative mentality, he has become an inevitable part of Christjodi College of Management and Technology. We are fortunate to have you, sir, on this gracious occasion. I also express my heartfelt thanks to C.A. Prashant Srinivas, Chairman of ICA Kottayam Branch, and C.A. Prem Sebastian, Secretary of ICA Kottayam, for their unstinted support of this event. Dr. Anu Anthony, NAC IQAC Coordinator and Postgraduate Course Coordinator, is an outstanding mentor who does have nonsensical mentality towards issues of variegated importance. Through her unparalleled presence of mind and unprecedented coordinating dexterity, she has nurtured up a place in Christjodi family. I thank her for her kindness and her interest, her hospitality, and continued support. I also express my thankfulness to all the faculty members and students of Christjodi College, faculty members from other institutions, and all those who have directly or indirectly assisted us in unveiling this program here in a splendid manner. With a heart full of gratitude to one and all, let me conclude the first day of faculty development program. Thank you so much.
Thank you, Justin. So the first day of our faculty development program organized by the Postgraduate Department of Commerce is being concluded here. Thanking all the dignitaries, dear participants, and all the well-wishers contributed to this endeavor. And we also expect your valuable presence for the second day of National Level Faculty Development Program conducting tomorrow. Thank you and have a great time ahead.